Well, it's been a sad 24 hours if you are someone who is bullish on the future of America. Uh, Lots to go over today by myself once again, but tons of stuff to talk about from CPI to some of the charts to some of what we had to hear last night. All on today's episode of Money Never Sleeps. Welcome back to Money Never Sleeps. I am your host today. No J Web, still sick. He should be on the show shortly, possibly him in house for a few episodes. I will not be here. But before we get into anything, I'm not a financial advisor. None of us are financial advisors. We're just a couple of guys. And just today, just me talking about how we feel about things in the markets, economics, and seeing where the charts and where some of these companies and indexes go. If you're going to make any financial decisions, I would consult with your own financial advisor or do your own research before you make any of those decisions. That said, and out of the way, it's been kind of a weird week, right? September's been a very volatile month. Intraday, back and forth. We're getting closer and closer to election season, so we are seeing some of that election seasonality. I don't buy that, but we're seeing it. And let's see if this time is different, like most people like to say. And I think that could go either way at this point. Obviously, I have my opinions on where this market is going. You guys know that I've been on this train probably for 2 years now, knowing where the macro will take us, right? But we did get some data today regarding CPI. CPI came in. I actually don't even have those numbers pulled up because the internet's messing around with me, and also because I am still feeling a bit under the weather. Let me just pull up Zero Hedge right here. But we did get the print, and we are starting to see people price in that it's going to be a 25 basis point hike. We just saw that. Interesting. That's fuck. Man, that's why we get fucking days like today. I'll bring it up in a second. Sorry, I'm talking to myself. I'm thinking out loud. But I'm pulling up our CPI data. And here it is. CPI month over month, 0.2% expected, 0.2%. CPI core, 0.3% month over month expected, 0.2%. That's interesting. That tells you that inflation is still somewhat hotter than expected. It kind of goes into what we had to hear last night at the debate as well. We'll get to that in a second. CPI year over year, 2.5, 2.5, yada yada. The core 3.2%, and then year over year 3.2%. So at expectations for the most part, CPI core coming in a little bit hotter. That's an indication that we're probably going to see some heat. Excuse me. Heat. In terms of inflation, we continue to see inflation. I don't care what anyone says. Everyday citizens of whatever country that is battling inflation, primarily in the United States for the time being, are not seeing their wages grow. They're seeing less hours worked, and we're starting to see the price of goods and the price of things that are necessary, services itself, in the United States remain relatively high. There is no way to combat that, and the continuation of rates being held for so high for such a period of time is going to cause an absolute catastrophe for the American consumer. You don't need me to say that. That's just fact, right? So when we look at how the markets are reacting to that, and this kind of ties in with everything we are seeing with this market being so heavily concentrated and what's happening in Asia, it's all interconnected, and it's so infuriating to watch, because at the end of the day, we do know how this ends up, and who is going to be the most hurt by this is the people who are also hurting the most right now, U.S. consumers. But looking at this S&P chart, I have to even go to the hourly just so you guys can see what happened. Right? So we're getting this is Friday, Monday, Tuesday, Wednesday, market open right there. Major red candle on the hourly. It was down 75 points to start the first hour of the trading day. Gets as low as, I believe, 89 points or so, and then it starts to rally from there, right, on the hourly. This is 100% Ponzi type of market. I'm not saying it is a Ponzi market, but it's a type of market where it's just trading, liquidating people back and forth. A lot of that does have to coincide with the yen. Not surprised if the Bank of Japan did intervene to prevent that level from being lost, and the introduction of maybe more debt allowed there to be more collateral, more liquidity in the system for them to bid this market up. They're fucking running out of time. I'm sorry to say that, but you can only run this play so long before things start to fall apart. Next week, we probably are going to get rate hikes. I think that their 50 basis point rate hike isn't out of the realm of possibility if the Fed feels like there's been problems in the system. At least 25 basis points. That's where we're probably going to get. The markets are either going to love it or hate it. I'm telling you that Asian markets are going to hate the prospect of America cutting rates, because that just means the dollar is going to get a lot weaker and the yen's going to get a lot stronger, and they are over leveraged at the top. And this is something we talk about. This is the carry trade. But this entire move, I honestly think that the S&P should probably be a lot lower. I think we should be testing lower levels somewhere south of here, 51.16. I think the 5,000 level is where we do need to go to. If I'm looking at this too, what's going on here, and this is just the hourly, and this is just me being an asshole because, sometimes I have to be. I think a wave 3 is near. I'm honestly convinced that I wouldn't be surprised. Let's put it this way: I wouldn't be surprised if we get a major wave 3 that takes us well below the lows of 51.19 that we got back here in August the 5th. That would have been the carry trade. I feel like we're just going to absolutely just round trip on this one. I understand that the market's up today, but the market's been in a downward trend for the past month or so. Now we have to really question whether or not there's enough juice in this market to push it up a little bit higher. Is there? I don't know. I think we get these days where, 1 day, 2 days, maybe 3 days where it rallies, but then everything gets reversed. I mean, this morning, everything from yesterday was reversed. A lot of people got out of their positions. They sold off. Now they're bidding it back up. And I just saw this, and that's why I was talking earlier when I looked at Zero Hedge. But let me pull up the box score real quick and look at the reverse repo. Yeah, okay. Give me the daily. Yeah, there we go. For the reverse repo drained once again. I believe it's at 278 billion. Let me see if I can get this correct. 279 billion, the lowest since May of 2021. When we look at the reverse repo, there are players using this facility, and this probably will drain, but this just goes to show you that there's a need for liquidity, a need for collateral. Yesterday we got a lot of news out of the banking sector, and it seems like the banks started to be in a lot of pain. Today they're down once again, not necessarily as bad as yesterday, but here's the thing about the banks and everything that's happened, since we did the last show. Everyone talked about the regional banks for such a period of time. It's never been about the regional banks. It's been about banks that have had high amounts of customer deposits that are uninsured, high amounts of FHLB that's operating as a percentage of equity, and some of those loans that are coming up due within less than one given year. There was a lot of them. We talked about Schwab. We talked about who are some other ones? USA Federal Savings. Truist Financial is another one. A lot of these KeyBank and US Bank are up there. So there's a lot of these banks that, do have a lot of uninsured customer deposits. They're whale banks in itself, and they're the ones that are probably the most exposed for any type of chaos, similar to what we saw in March of 2023. It's something that we kept on talking about. It hasn't been seen because obviously there was a BTFP, and then there's been collateral, and now you're starting to see, and this is just in the U.S. In Japan, there's a bunch of banks that are in a lot of trouble in that regards, and that's why we continue to see this yen carry trade get worse and worse. The leverage builds up. It's going to be wiped away at some point. When? Who knows? Honestly, probably sooner than later, because I think there is a bit of panic in the air amongst some of them financial institutions. But, we saw JP Morgan yesterday drop roughly, let's see what it was. JP Morgan dropped a good amount yesterday. Yeah, JP Morgan dropped 5.19%. It was down as much as 7.5%. Went to the $200 level, bounced. Again, I'm not going to do TA on them, but Bank of America, it's another one. Warren Buffett continues to offload shares. I believe he sold almost $300 million worth of shares yesterday. And speaking of people who have been selling shares, it's the guy that was on TV today, or was being interviewed today, Jensen Huang. Sold another 50 million yesterday, right? Why would he be selling 50 million if he was bullish and continuing to sell, right? It's because a lot of these people probably see the economy better than the U.S. consumer is, and a lot of people who are invested in the markets. You're being promised a soft landing. You're being promised all these things. You're being promised that this is the future of technology, that there will never be another human who's going to be write another line of code because NVIDIA AI will be able to perform such tasks. You're being sold on things that aren't likely to ever possibly come true in a given time period or a given time horizon between now and say 2028, right? This is a very much so a bullshit market. I think a lot of people are slinging bullshit. I'm not saying that Jensen is, but I'm saying a lot of things he does say are worthy of being questioned. I think that it's really interesting that we got news on the fact that there is no DOJ, antitrust that was sent to NVIDIA that wasn't delivered. NVIDIA comes out after the market and the following day and says, we never received it. And now there's, documents that are circulating around Twitter saying that they did. Now, with this little rally that we're seeing in NVIDIA, because he's talking up the chip today, I wouldn't be surprised if two things happen. One, this little gap here at 117 gets filled, and that becomes major resistance, and we see the next tumble. And I wouldn't be surprised if we do see an actual statement put out by the DOJ, right, regarding the situation. Everything right now seems to be on a funky fucking timeline. And whether or not it comes to the point where it matters for us, it really depends. I think a lot of it right now is just these people are very heavy in the trade. Japan is definitely heavy on this NVIDIA trade, and that's why you started to see the yen start to lose value, lose strength today, and we started seeing the U.S. markets pump. This level right here, just look for 116.81, right in that range. I think that gets filled. 117.52 seems like that's where it would find resistance. Doesn't have to, could push up higher, but if we're looking at this here, volumes are coming down as the price is kind of trying to push up here. So I don't buy this rally one bit. We'll just have to see them, but I do have my targets, and I do think that NVIDIA starts to roll over here. We could say that maybe $82 is the level. It's obviously going to be tested at 96. It's going to be see if it can hold at 90, but I think 82 is the level that eventually needs to come down to. Maybe that's after a little bit of trading, maybe a couple of squeezes, who knows? But that's the level we're watching. I'm going to highlight this one. We're going to make it extra thick, and then we're going to make it green for NVIDIA. Actually, you know what? Let's make it orange. Orange for NVIDIA, right? Jensen Huang talks a lot, and I think that there's a good chance that not everything he says is 100% actionable, or maybe a bit hyperbolic. I'm trying to choose my words carefully here. And I wouldn't be surprised with everything that we continue to find out about NVIDIA that they would be, that maybe there's a day that he comes to testify before Congress, right? It seems like a lot of tech companies do that when things aren't maybe as transparent as they should be. And eventually, Zuckerberg's testified before Congress. Tons of people have done it, right? Doesn't mean anything bad has happened. It just means that they want more information on potentially, maybe how one of the world's largest companies absolutely starts dumping, and they find out that there's only four people who are buying the chips, 4 customers, and they wonder, like, how are you able to generate that much revenue? There's a lot of information that is still yet to come out. We're going to keep watching to see how this vendor financing plays out, because again, it's not illegal by no means. I'm not accusing anyone of doing anything illegal, but it definitely is concerning that there is not a lot of transparency there. And, they have essentially no in the entire market share, they have no real competitors, right? I think that's part of what this antitrust subpoena that was issued, that may or may not have been issued, is kind of hinting at. So we'll keep an eye on that. But NVIDIA is part of the reason why the S&P is up today, and the NASDAQ, right? You look at tech right now across the board. Sure, it's up, but NVIDIA's up 5%, Apple's up 0.5%, everything else up about 0.5% or so. NVIDIA up 5%, bit of a squeeze. Outside of that, we can talk a little bit about the yield curve real quick. We're getting so many recessionary signals. It's absolutely mind-boggling, and we're being told very different things. We'll get to the debate in a minute, I promise you guys. But we're above the yield curves. Is no longer inverted. It is reverted back to being positive. That's a good thing. Obviously, when you get down here, that's a signal of eventually a potential recession coming. We're in the recessionary period right now, and it's good to know that this signal is operating, that the markets themselves are pricing in, because what we're being told is not what the markets are pricing in. Gold is sending a warning. The Treasury yields are sending a warning. U.S. oil is sending pretty much, this is U.S. oil's chart, but oil in general is kind of sending a warning that there is no demand. And we continue to see these numbers. We continue to see all this data that's coming out of, manufacturing, consumer confidence, consumer credit going absolutely crazy. A lot of people are using credit. You can say that's bullish for credit card companies, but when those delinquencies start hitting, it ain't so bullish. Just letting you guys know. But so looking at the yield curve, it's absolutely reverted back positive. And when you get something like this, there's a good chance that we're going to break out and keep it up above here. I think that we're long enough in the cycle, we're going to get those cuts. And when we get those cuts, this is going to be going a lot higher. It takes some time. Maybe it doesn't. Who knows? But we're here for it. And we have to acknowledge that we are positive now in the 10 to 2-year yield spread. Outside of that, looking at TradFi real quick, NVIDIA's up 5.5% right now. The S&P is up 15, NASDAQ's up 200 now. The Dow's only down 86 after being down 700 earlier in the day. The Nikkei earlier last night was down 800, but it looks like it is, man, see these wicks? These wicks are so fucking aggravating, because that is intervention, 100% people buying up. And then we see it in the U.S. markets too. And when I mean intervention, liquidity comes in and saves the markets itself. We look at the yen real quick. Oops, didn't mean to do that. You lost the level of 141. You went way below it. You went all the way to 140.73. Wicks all the way back up. Now you're trading sideways along this. You can only hold this up for so long. This neckline wants to break so bad, in my opinion. And when it does, the yen's going to get way stronger and the dollar's going to get weaker. And that's probably coincides with the rate cuts that are coming. But if that's the case, then everyone who's in the yen carry trade is probably going to get spanked. And that means equities are going to come tumbling down. So when we're seeing these rallies right now, obviously that's the yen coming into the market. It's obviously liquidity from the reverse repo coming into the market. You need to be putting up collateral. We're seeing the value of these treasuries and the bonds go up in value because people want them, because there is a collateral shortage and people are preparing for the possible worst. That's why we're also seeing the VIX stay relatively high. The VIX getting crushed a little bit today, but that's because of the S&P just reversing all those losses. But when you look at this, now my chart on the daily doesn't look so fucking weird. It looks like this is a wave 1 that we got. Wave 2 is what we're currently living through. And I think that these rallies end, honestly, they probably are short-lived in this market from here on out until the end of the year at least. I think that we are due for a wave 3, and I don't know if that comes tonight in Asia now, in Asia, and then into the pre-market hours of the U.S. futures, or if it's going to come, into Friday. You start seeing some of the sell Friday, and then Monday you start seeing the sell-off. I don't know when the sell-off is going to happen, but looking at this, it's very heavy. I don't care about oscillators down here at the stochastic RSI. We remain in a very different situation than we were, say, over here. When we were oversold, there was plenty of room to go up. Even that was pushing it, to be honest. But we're in a very different place right now with the markets. We're seeing the banks having problems with liquidity. It's a matter of time. That's all I can say. And that's probably the best transition to go into what happened last night when we talk about the debate, right? I'm not going to get political. I'm just going to say that it was one of the worst debates that I've experienced and witnessed, because there was very little that was discussed when it comes to the economy. The extent of which was, do you think Americans are better off now than they were 4 years ago? And I think that's something Americans can ask themselves. And it's very obvious, right? you are in charge of your own life. You live your life. You're paying your bills. You're going to work. Maybe you have multiple jobs. Maybe you don't. Maybe you don't have to work because you did well in the stock market in the 2020, or you did really well in these past 4 years. You know your life. You know how hard or easy it has been in these past 4 years, right? What I would like to have seen, and I don't think that either candidate has the capability, and maybe one is more suited to putting someone in charge that could potentially make some sense and understand the intricacies of both the US and the global market. And I'm not talking about just the stock market, the equity markets. I'm talking about just economics basics that could prevent potentially what is another catastrophe, another financial crisis. But neither candidate understands anything about what we talk about on this show, right? They understand the market goes up, you know, they don't necessarily talk about liquidity in the system. They don't talk about collateral. They're not going to be talking about some of the things that we're seeing that these companies are doing because it doesn't apply to, right? It does not apply to them. It applies to you. Uh, we have to understand that what some of these companies do at the top definitely trickles down into your daily life, right? If companies feel like there's no incentive to, they have to, I'm trying to think of the word. If they're trying to, get lean in order to keep the company running, they have to lay people off. Well, obviously that's going to impact a lot of individuals. Now there's a lot of people who are on unemployment that don't necessarily have money to spend in other places. And then the people who are working at the other places where those people usually spend, it's a spiral. It's going to continue going out of control. But a lot of this does come with what's going on in the banks from what they messed up in 2020 when they were buying the bonds. And now, rates are 5.5, and we're praying pretty much for a rate cut. And yeah, I think some people are praying for a bigger rate cut than others. I think they should have cut a long time ago. I also think they should have, I think that this whole rates hike cycle absolutely didn't work one bit, because now that we look at it, inflation's still somewhat hot. People are, you're living your life. You're going to know if you're going to the store and things are more expensive now than they were a few months ago, or if you feel like your dollar doesn't go as far as it did a few months ago, right? And if that's the case, then it's like, what was the point of any of this? For the American people, for consumers, what was the point of any of this? And then you have, proxy economies and governments like Japan, who are absolutely ruining potentially ruining the lives of so. And I don't mean the government of Japan, but the Bank of Japan, definitely by their monetary policy, ruining the lives potentially of so many people in Japan for risking another lost decade, very similar to 1990 all the way to 2008. And I mean that because we know that the pensions are highly, highly tied up in the Nikkei and the equity markets. So if that carry trade unwinds, you're going to see a lot of people that are probably be unemployed. You're going to see a lot of people lose a lot of their wealth. What the yen does in the years to come, anyone's guess. I think can go to 300 to 1 to the US dollar. US dollar just gets stronger and stronger. Maybe it just builds another platform for another, carry trade to happen. But with what happened last night, you should be concerned about the markets, the economy. You should be concerned about that, because that's so important to your and vital to not just your life, but everyone's life around us, right? There's a very good chance that we continue to see unemployment rise significantly after the start of the year. I think that there's a good chance that we can have a year of just unemployment rising continuously. Maybe it stops at 7.5%. Maybe it doesn't. And that's even a big jump from where we currently are. But you've been told a lot of things, and there's so much noise out there. And it's not just in the people that were running last night in the debate or at the debate. It's also just, a lot of these people who just don't necessarily know what they're talking about. And that's problematic for you, because a lot of people will take what people say at face value. And I'm talking about analysts who are saying one thing but doing another. CEOs that are saying one thing and doing another, right? Dumping shares while talking up the product. Like, there's a lot of things that could potentially be a sign that maybe things aren't as nice as they are, or they appear to be, right? I don't care if the market's at an all-time high. I don't care if, we're seeing a bit of a squeeze here. If we reverse all the losses intraday, to me, it's one big bubble that will pop, and it's a matter of when the liquidity in the system goes absolutely dry before something breaks. Maybe it takes a rate cut to finally ignite some type of motion in the markets that decide, you know what, yeah, we can finally breathe and we can kind of let this go. So those are just some thoughts about what we've seen. I think a lot of what we saw last night more so isn't anything necessary that's going to impact. There's no promise of anything that would positively impact the future of the U.S. consumer. Let's put it that way. I think a lot of focus wasn't about that too, just to be honest. But I think that there's a good chance that we continue to see problems for the U.S. consumer and generations, younger generations, trying to get ahead. I continue to see posts, and we see these posts all the time on Twitter, whether or not they are accurate or not, talking about inflation, purchasing power between now and the 1980s, saying something like 86,000 back in the 80s is equivalent to making $246,000 today. It certainly might not be 100% accurate, but it's definitely not inaccurate. There is definitely a heightened increase, and there's definitely a weakness. I would say an increased weakness in what the dollar can get you as time goes on, and it's probably going to continue. The hope and unfortunate thing is that a crisis similar to 2008, great financial crisis, is able to tamper some of the weight of inflation because demand is just so weak that we start to see some type of return to normalcy that allows people to get ahead. And you got to go through the fire and the flames and the ashes in order to come out on the other side and hopefully have a chance at this, because as of right now, it does not seem very optimistic for a lot of people who are just trying to survive. Maybe not even people in the markets, just people that are trying to raise a family and then live their life and enjoy their life too, right? You only got so many years on this planet, and if you're struggling and there's no chance of you finding a new job or being able to pay your bills or even to own property or any type of promise that people once had back in the 40s to 50s all the way until I'd say honestly 2008, a lot of that's gone. A lot of these tech companies probably going to lay off a lot of people. Those are some of the jobs where there's a lot of money. Trade jobs, those are probably going to be the most lucrative, but looking at things right now, it's not very promising. So I don't want to crash. I obviously am positioned for one, but I do think that in the long run, it probably will cause the least amount of harm, because the alternative is hyperinflation and wages don't go up with it. So yeah, and that can't happen, right? The dollar would be essentially worthless at that point. I don't think that that's going to be allowed. Look at how Japan protects the yen. So I think we'll leave it at that. And I think Japan protects the yen. I think we'll leave it at that. Obviously, just want to talk about the economics and the implications of what last night meant and also what's going on in the markets. There's a lot of noise. Doesn't mean that it's all accurate. So just like I said about financial advisors, do your own financial advice speak with your financial advisor for financial advice or do your own research. But it's just good to ask questions sometimes in these markets, because if the market seems so far one way, it might not be. But leaving it at that, we're probably gonna have a different schedule for the next week or so. I will be gone. So take care, everyone. Follow us on Twitter, like, comment, subscribe, do all that stuff, because eventually we will all get back together on the show and we'll have a normal show. But just wanted to get this out there early, and yeah, just to watch for the rest of the week, because it honestly could go one way or the other very drastically, and I think it's going to be a drastic move if it does come. I do think the volatility is here. It just you're just waiting for that shoe to drop. So take care, everyone. Talk to you guys soon, and we'll see you all next time.